Hello, this is Mike Swanson. I'm here today with David Skarica, who runs the website addictedtoprofits.net. His camera's not working at the moment, but that's okay because we got a lot of charts to show you and a lot of things to talk about. I'm just gonna switch real quickly to the charts. How you doing today, Dave?
I'm pretty good. It's been an interesting few days, to say the
For
least.
sure. Well, we haven't done interview like this for a while, maybe 2 months. I haven't even done any YouTube videos in almost a month either, and that's frankly because I didn't really think much was going on. But suddenly, all that changed out of nowhere. Bank runs, chaos in the streets, and wild gyrations and all sorts of financial markets. I mean, but hopefully none of this is impacting you. I don't think it is. You're living in the Bahamas.
I was pretty new in terms of my positioning. I was pretty neutral. On Friday, I actually put out a few shorts. I put 3 companies out short, and it was the first kind of real getting back onto the short side. Really, I've been doing nothing. Again, you're talking about nothing happening. You look at this chart you have of the BKX here. My opinion was like in October when the market bottomed, was that like nothing was going on, like you said. And, the BKX, you can see, has a range between 95 and 115. And the S&P had a range of roughly 3,800 to 4,100. And yeah, it was doing nothing and nothing. Okay, maybe a few stocks went up and down. But other than having a couple longs, being long some PMs, and I'm going to be honest with you, I took a bit of a hiatus because you understand, we met in 2002, right? At the time, I was 23 years old. And I've been writing my letter since 1998. And, and also done, work for other companies and the whatnot. And I was just like, I did a lot of option trading last year. And by about October, November, I was finding myself to be kind of burnt out. And I'm like, you know what? I've been doing this for 24 years, basically, without ever just always writing a letter, maybe take a week or two off. But so I was like, you know what? I think a month or two just to kind of clear my head was good, and I'm a big soccer and football fan. And, you had the World Cup in November, December, and NFL football. It's like the only time in my life that was going to happen. So I was like, you know what? I'm going to watch some of the games and hang out. But then I decided like late last week, I was going to get active. So I put these 3 shorts out, and I haven't looked at them because I was out the last hour or two. But I know 2 of them were down pretty good today, like 3-4%. I'm going to look at them right now. Yeah, one is down 3.5%. And yeah, anyhow, I don't need to talk too much about that. And one of them's flat, and one of them's down like 3% as well. So anyhow, yeah. Now I'm going to be much more active, and I really think this is a game changer with these banks, because you look at that chart of the BKX. I just don't think we'd be acting like this unless there's something seriously wrong. No, that doesn't mean it has to like collapse tomorrow overnight and we're really oversold. So probably some of these things are going to bounce pretty hard at some point in the next week or two. But I just think when you look what went on is, I think the whole bubble that happened after COVID, when they dropped rates to zero and they printed trillions of dollars, I think it distorted these asset bubbles and markets even more than maybe I even thought. And I wasn't exactly a raging bull, right? And I think you're seeing that blow up now. And I think there's this whole thing. If I can just quickly say what I think it is 3-pronged at these banks. Number one, you have these assets go up, and the things that they own no longer, be it bonds, stocks, real estate, are no longer worth what they were worth 1 to 2 years ago, right? And then number two, and they did a lot of lending to these kind of be it a tech stock or lending out for real estate, whatever it may be. Number two, they did a lot of that issuing their own bonds, so they could issue a corporate bond at 1, 2, 3%. Well, now it's probably closer to 5 or 6 or 7%. Probably a lot of these companies are almost junk bonds now. These banks you see basically going under. There's one called WAL, which is a Western Alliance, which went down 47% today. And it's like a bank like that is probably, if it were to issue a bond, that would be in the double digits. So they can't really issue that. And number three is one thing that's been, I don't think it's really surprising, but one thing that's interesting is none of these banks are giving anything on savings accounts. Like, I know, being from Canada and using a Canadian bank here in the Bahamas, I use Royal Bank. Basically, Royal Bank is paying like 1 to 2% in a savings account, and and the short-term rates in Canada, like the United States, are 4 or 5%. So who the hell would want money in a savings account when you can go buy a 1 year or 2 year Treasury, for 4% or 5% and get 3 to 4 times what a savings account is giving? So I think that's sucking capital at all these banks. And one way that banks make money is that they continue to make new loans, so they have new streams of revenue via interest. Well, they're not going to be making new loans now because they don't have the capital injection via deposits, issuing their own bonds, etc., to do it. So one interesting short I'm going to see going forward here on any kind of bounce is, in my personal opinion, is the home builders in the United States, because they're all kind of rallying a bit today because interest rates on the long end are down. But as we saw in the financial crisis, that's not going to mean that much if all of these banks are cash strapped and they're not going to loan anybody money. So and remember, a lot of these banks that are going under, like Silicon Valley, they did a lot of business with Silicon Valley. And I think you've already seen a lot of layoffs in that industry and sector, and in places like San Francisco and Seattle, where a lot of those people are employed. And I think you're going to see even more layoffs. And these are good paying jobs, right? Someone who works at some tech firm in San Francisco or San Jose, or they make hundreds of thousands of dollars a year. And so that's going to, I think that's going to start filtering through the job numbers and just spending in the economy in general, et cetera. And it looks to me like, and you put up the Fed fund futures when we were talking, it looks to me that the interest rate hikes are basically done. It's about 50-50. We get one in March. And the Fed fund futures, if you go out to December now, like that is now totally changed. Like, basically now they have an over 50% chance that rates are going to be 75 basis points lower than they are today, right? Or even lower than that, but basically at least an over 50% chance, and a nearly 90% chance that they're going to be 50 basis points lower than they are today by the end of the year.
Well, that's one thing that's pretty amazing about what's transpired here. Last week, Jerome Powell gave a testimony to Congress, and in it, he talked very hawkish about interest rates, and they have to stop inflation. And the odds of the Fed fund, the odds of the rates were that there'd be a 50-point rate hike on the March 22nd meeting. And gold fell, the stock market fell. And then in 48 hours, all this shifted to a possibility of no rate hike. And then this morning, that Silicon Valley bank failed Friday, of course, and there are other banks under pressure too. Another failure by some crazy crypto bank. But before the open today, the odds were there'd be no rate hike at this March meeting, and then by noon, that changed to an 84% chance of a rate hike, of a 25-point hike, and now we're back to basically 50-50. So these odds of these rate hikes are certainly changing almost hour by hour. But I think what's important now is that we're definitely at the end of the rate hiking cycle, but it's not already ended already. It's going to end at the next meeting. It would certainly appear at this point, because it seems like one of the, as you mentioned, these banks had their asset value shrink, the securities that they own fell in value. Now, in 2008, it was the subprime mortgages that represented about 10% of the balance sheets of many banks. They were worth zero. That's not what's happening now. What's happening now is that the safe treasury bonds that they bought 2 years ago when rates were zero have fallen in value, not down to that they're worthless, but down in value, just like they have for everyone that has a brokerage account and owns bonds and bond funds. They saw them drop in value last year. Well, it happened to the bankers too, and that's impacting their balance sheets and caused a run on some of these banks last week. And now the Fed today has taken emergency measures and pledges to create a special lending program. So if banks need, extra money for other depositors who want to get out, they can, get this loan mechanism and it gets money that way. So some wild action in events happening so quickly here, Dave.
Yeah, and like I think too, what's interesting too about the whole bust is I think again, like with a lot of these banks kind of being tech centric, and I think one thing that's different about this boom, especially the last since when rates went to zero, is remember the '90s boom in tech, interest rates were high, so most of those companies were doing venture capital and raising money through equity, and then they all just burned through all their cash and they went under because they weren't sustainable businesses. But now a lot of these companies were able to secure debt through cheap means and through say a lot of these banks that have gone under. So I don't know because I haven't crunched the numbers, but when you look at like a stock like Roku has a big amount of money at Silicon Valley Bank, I would think what would happen is probably Silicon Valley Bank underwrote some of their bond issuances, or bought some of their bonds, and then they in turn parked the money there. So what I'm trying to say is, what's interesting, where you said subprime was all these like overvalued houses and these mortgage-backed securities that are all leveraged. Now it looks to me like a lot of this was loaning out money to these companies. And you remember, you're loaning out, even though it's debt, you're loaning out these companies thinking they're worth so-and-so, right? Like you think some company is worth, when you loaned it out back in 2021, this company's trading, I'm just saying, I'm not going to use any companies specifically. Let's say company ABC is trading at $200. Well, now it's trading at $40. Well, those bonds you issued when the stock was based at $200 was also based on this company being a $200 company. Now it's a $40 company. So what I'm trying to say is these companies are not going to have access to that debt anymore. And if they do, they're going to have to sell debt. Me and you are gold investors, and you saw this in the mid 2010s and teens, with gold stocks when gold, went back down to 1100 in 2015. If you were Newmont or Barrick, or, and these are the big companies, or definitely a smaller cap company, you had to, issue these bonds. So you issue your bonds at a much higher interest rate. And actually, because they couldn't afford to take on debt anymore, those companies, if you go look at what from like 2014, 13 to like 2020, what Newmont, Barrick, those companies are actually paying off their debt because they were like, we cannot issue more debt because this debt's going to be at a higher interest rate. And because we have less cash flow because gold prices are lower, we need to pay off this debt. So what I'm trying to say is these tech companies are not going to go to the market anymore and not doing that. So I said, you said, like, noted, like it's a whole different thing now. There are MBS still, but they're not leveraged and packaged like they were back in 2006. But now it seems to be the epicenter of this kind of blow up in a lot of these banks is loaning, and I've been talking about a corporate debt bubble since 2014, 2015. And that's the issue with like, they say, being early is the same as being wrong. That's the issue with talking with like macro kind of like predictions like this, that, hey, we're in this huge corporate debt bubble. And all you got to do is go to the St. Louis Fed website and you see how much, both debt and, a corporate graded debt has been issued since 2010. And I think now that bubble's kind of blowing up, because I think a lot of what's going on is that debt not being worth as much on these banks, kind of balance sheets, et cetera. Right. So, and it does see what it kind of reminds me of is not so much like the financial crisis. Remember, the financial crisis, the mortgage-backed securities, hyper leverage, the big Wall Street banks. The big Wall Street banks seem to be okay right now. It really looks more like almost like the S&L crisis back in the early 90s, where all these small savings and loans were paying off these big interest payments. And then when rates went up, economy went in recession, they could not pay those depositors those rates anymore. And people forget that the first bailout wasn't long-term capital management in 1998, wasn't the financial crisis in 2008. The first bailout was actually, I think it was about 100 billion. They bailed out a lot of the savings and loans back in like the early 90s. So, and actually for some reason, no one really, maybe because the numbers weren't that huge, no one really got up in arms about it back then. But that was really kind of, the first blow up in all this. And the last thing I like to note, getting away from the banking and financial side of it, is, we saw gold up $50 today, and gold had kind of sold off on the fears that the Fed was going to keep these rates higher for longer. And I think, forget the Fed fund futures, I think the biggest example of, maybe that, the Fed is now nearing the end of this cycle, or probably is gold, being up to over 1900, silver back up to near 22. Silver's up almost 7%, gold's up almost 3%. I think that is a kind of sign. And if you go look at all the past loosening cycles, like the early 2000s, 2009 to 2011, 2020, whenever the Fed cuts rates, it seems that maybe as the bull market matures, people get more aggressive and they get out of precious metals. But that first 2 to 3 year period, precious metals are about the best performing sector. So that's an interesting thing to watch, because they may start to anticipate, that the Fed is now going to stop the tightening cycle and maybe begin to loosen late this year, early next year. And remember, last year was as hawkish as anyone. I kept telling people the Fed is going to raise, inflation's at 8%. The Fed is going to raise way more than you think. They know they made a mistake creating all these asset bubbles. Now we're seeing the problems with this, in the banking sector. But now I am firmly in the group that we are near the end of these rate hikes. Maybe we'll get one more quarter point. And probably, by the fourth quarter of this year, we'll probably start to see rate cuts. Definitely by the first quarter of next year. So another thing to watch is inflation. The next few months, we have very positive year over year inflation comparisons. This time last year, oil was near 100. Now it's, in the mid 70s. So we're going to get those comparisons, especially in commodities, very favorably. But if they stop, raising rates, and if they have to cut rates and print money to do banking bailouts, you're going to see inflation probably start to, climb again next year. And I think the thing you really have to look at, because it does look like this banking crisis right now, again, like I talked about S&Ls, it's like really confined to these regional banks, especially the ones with like tech exposure and with like hyper leverage exposure in terms of being tech, crypto, et cetera. And I don't think a lot of the big European banks did that. So you could get a scenario of what happens, when the UK had to do that emergency loan for their pension funds, back in September, and then the pound tanked to almost par and tanked, really quickly overnight. If the US has to step in and the Fed has to do some kind of emergency loan to bail out some of these banks or keep them, basically from going under, you could see something like what happened in the pound in September happen to the dollar, and I know a lot of people, and I was bullish on the dollar most of last year. I started getting less bullish late last year, but I think definitely you could see that, because it doesn't look like these problems are going on in Europe. And the ironic thing, I'll end up in this note, is that everyone was talking about Chinese real estate, Chinese banks, European banks, Credit Suisse, Deutsche Bank, these being the epicenter of the next crisis. And it looks like it's going to be these regional banks in the United States, is the epicenter, not any of these other things. That's how the market. That's why it's tough to trade these. It's tough to trade markets because something like this comes out of nowhere.
Well, with everything you said, I think, it's hard to predict everything that's going to happen, as you just noted. But if we just look at the most obvious things, and that is, as you stated, the Fed is at the end of the hiking cycle. And unfortunately, we haven't been able to see the Fed get interest rates above the CPI annualized inflation rate yet. So if it abandons, if it's not able to do that, then it's going to fail at truly defeating inflation, because it's worried about, bank runs, preventing bank runs. Well, that's an environment that's very bullish for gold. And I just have a chart here of the gold divided by S&P 500 ratio. In gold, this ratio went up last year because gold outperformed the stock market, and now it's about to break through the highs of last year. It's right on it. So gold outperformed the market last year. It's a position to simply do that again. And silver is the same story. So if someone wants a simple takeaway of what to do to make money and profit from this and protect themselves, gold and silver is the simple solution. And if things turn out, as you were saying, of lower interest rate cuts by the end of the year, it'll be a necessity to own gold and silver, because this is a mess. People were begging for a Fed pivot last year, but now that pivot could be happening with inflation not defeated. It's a complete debacle what we're now potentially
and the
facing.
analogy I would use, because we're coming from a much higher interest rate level than 2020, I would use it more again like that early 2000s, where you had a tech bust and you had a recession, and then they cut rates to 1%. I don't know if rates will go that low because of the inflationary problems we still may continue to have. But I think what you could see is, let's say they take half, they rates were 0. They've raised them to 4.5. So let's say they go back to say 2. They raised them 4%. They cut them 2% around the short end. Well, if that happens, again, you go look at what gold and gold stocks did. Well, they were doing that from 2001 to like 2003, 2004. The HUI, I think, bottomed at 38 and it went to 250. It went up 6-fold. And then ultimately it went to over 600 before the 2008 crash. So, it went up almost, it went up 15-fold, so actually more like 16, 17-fold. So like, I'm not saying we're gonna have those kind of gains because the gold stocks were, I think, even cheaper back then, but I definitely think you could see something like this occur, so.
Yeah, the sector can move fast when it does move. We know that. Well, as we wrap up, is there anything else you'd like to say?
No, I just think it's interesting. Like I said, like, I don't want to get too freaked out about like this First Republic Bank, for example, was down 61% today. I think it was down 75 at one point. I don't want to get too freaked out about like, oh, it's all going to collapse. Because remember what happened in 2007, 2008 is stuff started blowing up in 2007, and we didn't see the actual crash to the fourth quarter of 2008, or third, fourth quarter, September, October. So I don't know how this is going to play out. This is like, again, I think it looks like it's more just based in these regional banks. And obviously that can mean money can move into the big Wall Street banks. But I just want to say this is probably the end of the rate cut cycle. And the issue now is, because of that, they may add liquidity to the system, like I said, especially later this year into next year, at a time when inflation is still pretty high. And I think, because remember, everyone and their mother, as the old saying goes, on Wall Street has been saying that inflation will trend lower to 2%, but by 2025. Well, this is how you could probably get a scenario more similar to the 70s, or in both the early 70s and mid to late 70s, where inflation had the spike, came down for about a year, and then had a secondary and a third spike. And that looks like too it's going to happen. And maybe inflation goes down to 4 or 5% in the next 3 to 6 months. And then as they're going to loosen, until 5% is still historically, especially the last 30 years, pretty high. They could be adding liquidity into that. and you could see another kind of spike, here in inflation going forward. And then there's all kinds of other factors, like the debt is so much higher now, and this sort of thing. So, and remember, as the debt continues, I'm not talking about the debt ceiling debate. I'm just talking general terms. It being near 31, 32 trillion now. And getting close to 150% of GDP. It's like there's less room for them to be able to raise rates, because as the debt gets higher, you got more interest. Again, we're seeing that with these banks. They got a lot of debt, and now they can't afford higher interest on new bonds. So, and that's all I want to say is I just think this potential loosening cycle now into already a high inflation environment can go higher. And I really think this time, because I don't think we're going to get another tech bubble, especially like I said, these banks aren't going to loan to these tech companies this time. So that really bodes well for the precious metals. And I know people look at me and you as being these precious metal bugs and bulls, but you can kind of really see this scenario setting up now.
Oh, for sure. Well, thanks for taking the time to talk to me and everyone else out there in YouTube land. If you want to get more from Dave, go to his website, addictedtoprofits.net. Explore it. You'll find a place to subscribe to his free email newsletter. And if this is the first time you see me on YouTube, hit the subscribe button and hit the bell next to it. YouTube will send you an alert as soon as the next video is up. And we'll be talking with you later.
Yeah, thanks for having me, Mike.